All right, hello everyone. Tommy Sandvik here with the Bull and BearIT traders, and I have one question for you. Actually, a couple questions for you. If you have a lack of time and find trading to be difficult because you have to spend so much time in front of the charts and you have a very up and down percentage win rate, if you have that problem, then I have a solution for you. And if you just simply don't desire to be a high probability, low frequency trader, I have a solution for you. So what we're going to cover today is exactly, I guess, step one of how I've managed to how I've managed to trade on a very tight time schedule, and with that get very, very good results with my in-the-money rates, and have narrowed down so that you can accurately predict with certainly a high degree of probability where price is going to go. So without any further ado, let's get started. Okay, so as I said, if you're looking to have a good idea where the market is going to go, and you're looking to have high probability, low frequency trading that honestly just simply doesn't involve a whole lot of chart time, then this is most definitely a method for you. So what we're going to do is start out by talking about support and resistance. It's a very common method of trading, support and resistance. Forex traders use it, options traders use it. And that is basically finding spots where price halts a little bit. Then it might break and come back and test it, but it's these points where price is moving and then stops moving in that direction. So on this chart here, we've got the euro dollar. Actually, let me drop down to like a 15-minute here. So here would be an example, okay? Right here, support, because price has touched multiple times to this level. But that's on the 15-minute time frame. You can draw a lot of support lines. You could have a support line, you could have a line here, and you could put a line there. Kind of matches up. You see test, test, break, test, test, down. Okay, okay. But here's the thing, right? You want to know, is it going to break or is it not? Like every time price is hitting these levels, there's orders there, and those orders are getting filled every single time, and that's what ultimately causes these lines to break. So actually, the more that they're hit, the greater the probability that they break. So we're told the more they hit, the stronger they are, but in actuality, the more they hit, the weaker they are, right? That's because they're going to break eventually because those orders are getting taken out. So rather than trading on these points where price keeps repeatedly touching, I trade on zones, rejection zones, on a higher time frame. I'm going to show you what I mean. So we're going to go out to the 4-hour chart. Now, most people don't go really much higher than a 15-minute chart. Some might do hourly. I think it's fairly rare for people to use a 4-hour chart in binary options for sure. So let's just, let me just wipe away a couple of these levels here so we got a nice fresh look at things. And I do have a pending that might get triggered while I'm recording. So we'll see. Okay, well, we'll go with this for now. So here's the thing. What I'm looking for are locations on either the daily or the 4-hour chart where price historically hasn't just stopped, but reversed direction with force. That's what you want. Strong change in direction. Okay, so looking at the 4-hour chart, I went back, so you can look back in time and find the locations on the chart where you had a strong change in rejection, and then the kicker is that if price comes back to that same level, it will either bounce or it will go through the level with force. So for instance, if you take a look at this right here, it's about right. It's a little iffy. But anyway, just look at this. You had price come up here and touch this little zone. It rejects down, comes back, tests it down again, quite a ways. I mean, we're on the 4 hour here. So I mean, this is a few days. Finally comes, tests, and then busts through it with a big candle. That's what you want. What you don't want is price sort of playing around in the zone. You don't want price to be closing the 4 hour bars or the daily bars closing within your zone. You want locations of massive rejection. And it's actually interesting because if you look at this particular example, you have a little bit of something probably about here, right? So it's down and dirty because this is a little bit clunky to do in MT4. But anyway, so this would be an example of a zone that you would want to draw. What you have to understand then is that price is attracted to these zones. So you'll typically find, I mean, if you take this moment in time that we're looking at right now, well, if this was the top, where was the bottom? Well, I would say here. There's the bottom. So price is attracted. It's here. It comes up. I'm sure actually if we extend this, put this back a little bit. So here, reject, goes through, comes down, through, down, bounce. It can kind of adjust this here a little bit. It's not going to be perfect, but it's close. Okay. Anyway, so up, down, there we go. Now look, you have price came all the way back down here to touch, up, down, and then finally it breaks through. Okay. So understanding at a high level on a chart where the zones are that price is going to it's going to be attracted to like a magnet. And either it's going to bounce or it's going to push through it. And in the next video, I'll cover how you know that or how you can help determine that with high probability. But the key here is that you understand that what you're looking for on a higher time frame are points of rejection. Yes, it's wicks, but it's wicks where there's a wick and a strong push the opposite direction. That's what you're looking for, okay? So we go over here to the current 4 hour scenario. Now, unfortunately, the zones I had drawn originally when price was way down here, I actually was, they got erased. But I had a zone way down at the bottom, and I was just waiting for it to touch, and then it took off out of that zone. So if you were going to draw a zone at the bottom, you would draw it here because that's where price rejected from. Now, okay, so understanding, okay, we had someone today going, I can't understand why every time I take a call, the price is going down. Well, since the news yesterday, maybe if you look on the hourly, yes, there is an overall downtrend, but most importantly, this is where price was here during the news, and then we had spike up, spike down. Okay, so it was in the middle of these two zones. It's either going to go up and test the high, or it's going to go down and test the low. Personally, I am not interested in trading anything between these blue lines, between the blue zones. Not interested at all. I want high probability. I want to know when I take the trade There's a high probability of the direction that the trade is going. It's not based on indicators. It's not based on patterns. It's not based on any of that. It's based on the fact that at certain levels, price is going to, has in the past rejected, and there's a high probability it will do so again. Until such point as it comes through that area with force and completely takes it out. So this is step one. You've got to be able to look at the chart, identify these areas, and then draw the zone. You may ask, as an example of where I'm not going to draw a zone, you may say, well, look, there's all this rejection right here. Let me get a shapes. Okay, you might say, well, Tommy, there's all this rejection right here. Yeah, but look what happens over here. You've got price playing around in the zone, closing in the zone on the 4-hour chart. If you're drawing a 4-hour zones off the 4-hour chart, you don't want a 4-hour bar closing within that zone. That invalidates the zone. If price bounces with a wick or bursts through the zone, that's okay. Still a valid zone in the future. Case in point, look at this zone right here in the middle, which is where price currently is. The 4-hour shot through this zone, but then came back and rejected off of it once. So still definitely a valid zone. Right now, okay, so that is zones. Let's take a look at the Euro Yen, because I've been trading this one as well. So the zones here I drew back, I don't know, last week, and I've just sort of sat and waited. I drew this upper zone first, and then the bottom zone sort of started to form itself because we had test, reject all the way up, came back down. Sorry, let me zoom in. Came back down, didn't quite touch, came back down, touched, and is currently rejecting again. If you look back, it's an okay zone going back. It's not the cleanest. Looking in the history, like here you see it's kind of closing within it. So it's kind of a newer zone. But I've got this action here. It didn't close within it. It broke through it, came back, didn't close within it, and has been pretty forcefully rejecting off of it. So I definitely count that as a shorter term zone. And what you can do is learn to identify what's super crazy high probability zone, which would be the ones that price hasn't even come close to. I mean, the ones where price touches and then just shoots in the opposite direction for days, weeks, months at a time, those are the zones that are crazy high probability when you get up to them. Those are the ones you want to trade for sure. And then from there, you can work down to these shorter term zones, which still allow you to take trades with a high degree of probability. Okay, so why does this matter? It matters from a time perspective because you can just basically set alarms on your MT4 and walk away. You don't have to sit there and watch the charts over and over and over again once you've established your zones. So it's a great thing if you're in the house even to be able to just set the charts and walk away and chill out. And you don't have to watch every little minute movement. So that is all I'm going to cover for this video. How to draw the zones, what you're looking for with the zones. And just it is price action so much as it tells you by looking at the wicks, you're finding those spots of rejection, strong rejection, not just a little bit. By going on a higher time frame, that's an even stronger it's an even stronger method of rejection rather than using a 1 hour or 15 minute. Could you do it on 1 hour or 15 minute? Yes, definitely. But keep in mind that your probabilities are going to be less. Greater probability that the zone gets broken if you're just, popping around a 15-hour thing and going, well, you got like here would be one. Let's just for fun. And I have no idea if this is going to be valid or not. So let's just do this and throw this up. And let's just see what happened. Okay, 15 minute, it hit it, rejected. Yeah, so actually could have done that off the 15 minute. That would definitely be a point of rejection. So, definitely doable. But I prefer to stick to the 1 hour right now. I'm sorry, I stick to the 4 hour right now. And, at some point, yeah, may be able to do lower time frames, but you want to start with higher time frames, higher probability, less trading, and then over time, you'll be able to narrow that down a little bit more, and you'll get more comfortable with the concept, more confident in the concept, and then you can go on lower time frames if you wanted to. Start with 4 hour. Okay, so that is Tommy with the Bull and BearIT Traders. I am Tommy with the Bull and BearIT Traders. Don't forget to subscribe to our channel, and our website will be launching very soon, so make sure you check out the link below the video to get put on our pre-launch list. Thanks so much.